Hello, everyone, and welcome to our exciting lecture series on Principle of Accounting. And I'm your instructor, Jamal Haider. So, I am really grateful and thankful for your best wishes, and I'm recovering very fast. Please ignore coughing sessions during this lecture. I hope to minimize my coughings because I still have a little bit cough. Okay, let's move forward. Today we will start chapter 3, and our first learning objective is explain how accrual accounting differs from cash basis accounting. So let's explore that. So in order to explain how accrual accounting differs from cash basis accounting, so the managers obviously they want to earn profit. The objective of the investors is to search for the companies whose stock prices will increase. Similarly, banks are seeking borrowers who will pay back their debts along with the interest. So, accounting provides information to these people for making decisions, right? So, accounting can be divided into two. One is accrual accounting and one is cash basis accounting. In accrual accounting, the accrual accounting records the impact of transaction as it occurs. If transaction happens on 15 of January, the transaction will be recorded in the books of accounts on 15 of January. If the payment came in which was due for transaction 15 January on 30th of January, it will record on 30th January as well and adjust the entry as well, right? So the next point is the accrual accounting is also required by law, which is GAAP, generally accepted accounting principles. So the basic idea of accrual accounting is that it records revenue when earned, expenses, it records the expenses when incurred. Coming to the cash basis accounting, the cash basis sorry, the cash basis accounting records only cash transactions like cash receipts and cash payments. Cash receipts, for example, any sales happen, they don't go for on account, they just deal with cash basis. So the sales become their cash receipts, payments or expenses they become their cash payments. So it ignores important information that are used to make financial statements, for example account payable, account receivable, because they only deal in cash. So you won't see any accounts payable or accounts receivable. Let me just erase that. Okay. And cash basis accounting, they are in practical use, yes, only for smallest businesses, right? So these are the difference between accrual accounting and cash basis accounting. Okay, let's dive further deep into this accounting concepts of accrual accounting. So accrual accounting is more complex, and in terms of conceptual foundation of accounting, you can see the exhibit 1.3 in your book, that it is more faithful representation of economic reality than the cash basis accounting. So look at yourself. Can business only survive on cash basis? Never, because on daily routine it's a business daily routine or business norms that people deals in credit. So accrual accounting records cash transaction as well, such as when customers pay us pay the business their balances, means collecting cash from customers, receiving cash from interest earned, paying salaries, rent or other expenses, borrowing money, paying off loan and issuance of stocks. And accrual accounting also records some non-cash transaction, for example sale on account, purchase of inventory on account, accrual of expenses incurred but not yet paid, depreciation expense, usage of prepaid rent, insurance, supplies. You pay but The usage is not just consumed, right? Earning of revenue when cash was collected in advance. And now the time period concept in accrual accounting. Uh, the only way for a business to know for certain how well it performed is to shut down, which means sell the assets, pay the liabilities, and return any leftover cash to the owners. So this process is called liquidation, which means that going out of the business. But ongoing companies, they can't wait until they go out for the business to measure the income that they're going to distribute among the loan providers, debt holders, and the owners' equity or owners of the business. So instead, they prepare financial statements for progress reports, and who made them? Accountants. So accountants, they basically report at regular intervals the accounting information. So the basics accounting period is for 1 year. So around 60% of the large companies, they use calendar year from January 1st through 31st. We call this accounting period, right? A fiscal year may end on other than the 31st December. For example, many governments, they start from June June 1st to 30th June of the next year. For example, June 1st, 2019, 2020, right? So companies also prepare financial statements for interim period of less than a year. For example, let me just remove that one. For example, income statement for a month, 3 months, semi-annually or annually, right? Here comes our second learning objective, that is apply revenue and expense recognition principles. Let's explore that. So, when should you record the revenue? After it has been earned and not before, right? In most of the cases, revenue is earned when the business has delivered a good or has performed its services for the customer. So, there are two issues with this deal: when to record the revenue and what amount of revenue to record, right? So revenue is recognized when business transfers promised goods or services to the customer in an amount that reflect the cash or fair market value of other considerations that the entity expects to receive in exchange for goods or services. Now question should be that why there is a fair value of market of other considerations are recorded here. So in order to minimize the chances of embezzlement or fraud, for example, this is Mr. A and that's Mr. A's wife, that is B. Mr. A is the CEO of a company and Miss A's wife, that is Mr. B, Miss B. She has a business and Mr. A purchased goods from B and B delivered the goods, right? For example, the, the transaction goods that Miss B sent to A worth of $100, but since A is the husband of B and he said no, I'll pay you $10,000 for these services or goods that you sent me. So in order to avoid this kind of fraud or embezzlement, so that's why the revenue recognition principle, it includes fair market value of other consideration as well. So whether law forbids to buy goods of a wife's company No, but only if there is a chance of embezzlement. So if B's quality is of the top class and these goods can be sent on a fair market value, then you can also buy from your wife's company as well. Okay, let's move forward. So here's a global view of IASP and FASP, a joint standard that provides a consistent coverage and simplified way of recognizing revenue. I just want you to pause the video and read it by yourself. It's not a rocket science here. Okay, let's move forward. So applying the revenue and expense recognition principle. So here is exhibit 3.1, which shows two situations that provide guidance on when to record the revenue for Starbucks Corporation. In situation 1, no transaction has occurred, so no contract exists. So Starbucks corporations record nothing, right? Since they are just greeting. So in situation 2, a customer places an order for a latte. A transaction has occurred, so producing a contract that both parties are obliged to fill. Starbucks recognizes revenue when it delivers the product, satisfying its contractual obligation and entitling it to collect the cash. So the cash, sorry, so cash is received by the Starbucks and customer receives the product, right? So the amount of revenue to record is the cash value of goods or services transferred to the customer, right? They pay cash according to the fair market value of this latte. So that would be the amount of revenue that should be recorded. Okay.